Welcome back, everybody. Today we're talking about Coca-Cola, the 140-plus-year-old beverage company that's known to be a favorite of Warren Buffett, a master of holiday advertising, and a dividend king with over 60 years of consecutive dividend growth. And not that this should sway you in any way, but it's also my soda of choice anytime that I actually do drink soda, which is only like 2 times a month. But those 2 times, delicious.
You suck.
And while it's been a consistent dividend payer, overall Coca-Cola has underperformed the S&P 500 over the past 5, 10, 20, and 30 years. And it's down over 13% over the last 6 months. So were Coca-Cola's best days behind them, or are they still worth buying? Let's find out. But before we dig into the business, let's look at some basics for Coca-Cola's stock. So if we jump into Seeking Alpha, we see that Coca-Cola is trading at a price of $55.24. Over the past 12 months, they're down over 7%, and year to date, they're down over 12%. And if we just look for the past 6 months, they're down over 13%. In terms of dividends, they pay $1.84 per share, which works out to a dividend yield of 3.33%. And if we take a look at their dividends a little more closely, we see their dividend yield and annual payout, and they have a payout ratio of 68.68%, a 5-year dividend growth rate of 3.40%, and consecutive dividend growth of 60 years, which is just amazing. If we dive into their dividend growth stats a little bit closer, we see that their dividend growth has been pretty average at best, with the 10-year dividend growth rate being 5.21%, which is relatively respectable, but then it's been slowing since then, with the 5-year at 3.4% and the 3-year at 3.74%. All 3 of those are lagging their sector medians as well as their own 5-year averages. But Coca-Cola did just increase their dividend by 5% in 2023, and their leadership team has maintained that it is a priority for them. Just real quick, if we go to the Momentum tab, we can see that Coca-Cola has underperformed the S&P 500 on the 5-year, the 10-year, and even on the 30-year. Alright, so we have an idea of what their stock is doing and how it's performed. Let's talk a little bit about their business. So Coca-Cola is a beverage company that manufactures, markets, and sells various non-alcoholic beverages worldwide. The company was founded in 1886 and sells their products in more than 200 countries and territories under many different brand names. And outside of just the regular Coca-Colas, they have some of the most popular beverage brands on the market, including Diet Coke, Cherry Coke, Sprite, Fanta Orange, and many others. So how does Coca-Cola actually make money? Their revenues are broken down into the following 7 categories. You have Europe, Middle East, and Africa, which accounted for $7.5 billion in 2022, about 17% of their revenues. Latin America, which accounted for $4.9 billion, or 11% of revenues in 2022. North America, which accounted for $15.6 billion, or 36% of revenues in 2022. Asia Pacific, which accounted for $5.4 billion, or 13% of revenues in 2022. Global Ventures, which is their operating segment for brands that they've acquired or partnered with, including Costa and Monster, who they have a partial ownership stake in and a distribution agreement with. This accounted for $2.8 billion, or 7% of their revenues in 2022. And Bottling Investments is their footprint of bottlers, where they're continuously looking to refranchise these and find the right local partners in different areas of the world. Now, currently, their bottlers exist in parts of Asia and Africa, and they've completed refranchising already in North and South America, as well as China. And this accounted for $7.9 billion, or 18% of revenues in 2022. And then lastly, they have an eliminations category, which is basically used to reconcile revenues that may show up in multiple entities. This accounted for a minus $1.4 billion, or about 3% of revenues in 2022. And additionally, Coca-Cola's net operating revenue growth rates by segment are as follows. Europe, Middle East, and Africa, about 5%, including a minus 14% foreign currency adjustment. Latin America, 19%, including minus 5% of foreign currency adjustment. North America is 19%. Asia Pacific is 3%, including a minus 9% foreign currency adjustment. Global Ventures is 1%, including a minus 11% foreign currency adjustment. And then Bottling Investments is 10%, which includes a negative 9% foreign currency adjustment. So if we take a deeper look at Coca-Cola's revenue growth and we go to Seeking Alpha, we see that their revenue growth is 6.35% over the past trailing 12 months compared to the previous 12 months. So let's take a look at their financials. Now, Coca-Cola's revenue growth has been a bit up and down over the past 10 years. They had 6 straight years of revenue declines from 2013 to 2018 before starting to turn that trend around. Now, 2020 was obviously impacted by the global pandemic, but since then they've been on a good revenue growth path. International revenues continue to be a strength, obviously, since a bulk of their revenue mix is in the other geographic segments. But even North America saw 19% growth from 2021 to 2022, as well as another 9% and 8% in Q1 and Q2 of 2023, respectively. And being that more than half of Coca-Cola's revenues come from outside of North America, they've been hit pretty hard by foreign currency fluctuations as the strength of the US dollar has increased, as that had a 7% overall impact in 2022, another 6% in Q1 of 2023, and then another 4% in Q2 of 2023. Coca-Cola's management team has talked about driving growth through their streamlined portfolio of global and local brands and have stepped up consumer-facing investments that set the Coca-Cola system apart to deliver value in any environment. And we'll definitely be able to see the benefits of their operating structure when we talk about their margins in a minute.
Let's not talk about my margins, by the way.
Okay, so now that we have an idea of who they are and what they do, let's talk about risks. Risk number 1, a prolonged economic slowdown and strength of the US dollar could significantly impact their business outlook. A prolonged economic slowdown could mean that consumers are spending less and have to be more selective in what they buy. That could mean that brand name sodas and beverages could be substituted with lower cost store brands or alternative drinks. Now, I don't think this risk is high unless Coca-Cola's prices rise to a level that's significantly higher than the rest, because at this point, I do think that they are an affordable luxury that probably shouldn't see all that much impact. However, since Coca-Cola gets so much of their revenue internationally, it has been hit very hard by currency fluctuations. They have a history of reporting revenue growth on a currency-neutral basis, and they did this even back in 2020 and 2021 when the currency impact was positive, so it's not something that they just started doing. But it's unclear to me how much impact this whole dance that we're doing with the Fed and interest rates in the bond market is going to have on companies if interest rates end up staying higher for longer. Because just logically, if interest rates are going to be higher for longer, that could mean that exchange rates and the strength of the dollar could be higher for longer as well. So even if Coca-Cola's revenues continue to be strong on a currency-neutral basis, at what point does the actual money you get in your bank account matter more than a currency-neutral view of your financials? I'm just not sure. Because obviously the revenues are still positive, but there's a big difference between a 6% growth and a double-digit 12% growth for an investor. Risk number 2. Commodity and input costs could significantly impact their business outlook. As inflation has risen and the price of raw materials has gone up, Coca-Cola has been able to keep revenues up by raising prices. They have an iconic brand, and that pricing power is apparent. But at some point, there's likely a limit for what they can charge for their products. If input costs continue to rise, it could put pressure on Coca-Cola's top-line revenues or ultimately compress their margins if they need to keep prices down. Now, they have a couple advantages to help them mitigate this risk, and one just being they have a century plus of experience dealing with this, so that's definitely on their side. But number 2, Coca-Cola has some of the best margins in the business, and what that does is give them a little bit more wiggle room to be able to deal with rising input costs if prices end up getting too high. Risk number 3, misjudgments in advertising campaign strategy could significantly impact their business outlook. Now, this is a new one for me. I haven't talked about a risk like this before, but I think Coca-Cola's long history of having iconic ads and recent events that have happened with other beverages makes this risk worth calling out, because Coca-Cola has had many memorable advertisements like this, or this one, or even this one. Great ad campaigns and commercials have become part of Coca-Cola's brand, especially around the holidays. In today's social media-driven world, the chance of creating an ad or a piece of content that finds itself in the viral news cycle is high, and it can have a lasting financial impact on your business. And we saw this happen in 2023 with Anheuser-Busch and their Bud Light influencer partnership with Dylan Mulvaney. And regardless of anybody's feelings about that situation, which I have zero interest in getting into, but it absolutely impacted Anheuser-Busch's business with their sales dropping about 30%. And that 30% drop seems to have been sustained over the past 6 months since it happened. Now, it's hard to know how much of their ad campaign impacted the stock because the market overall is down, with Bud being down over 20% since the controversy in April, which, Seems like a lot, but it's also in line with other providers that didn't have a controversy. But we do know that sales were materially impacted for Bud Light, and that's the concern that matters for companies. Obviously, I think Coca-Cola has a wider target audience demographic, which in some ways can reduce that risk. But it also means that there's going to be a wider set of opinions and viewpoints scrutinizing every piece of content or ad that they make. And of course, just about every company has this risk, but I think for companies like Coca-Cola, where their ad campaigns have historically been a strength, it puts that much more pressure on them to continue their success in our current environment. But Coca-Cola has been one of the absolute best at doing this, so history's on their side. So now that we have a good idea of what the pros and cons of their core business are, let's look at how they've been performing operationally. So let's take a look at their free cash flow first. Coca-Cola's free cash flow generation has been steady after their refranchising efforts in 2017 and 2018. There was a slight dip in 2020 because of the COVID year, and then also in 2022. But the dip in 2022 looks to be related to an outlier number in the change in accounts payable in 2021. Now, adjusting that to a more normal level shows steady overall growth. From 2018 to 2022, their free cash flow grew over 56% from $6.1 billion to $9.5 billion. And over the past 5 years, they've consistently been using their cash flow to pay down their debt position, initiate share buybacks, and distribute dividends. All right, so let's take a look at their profitability. For Coca-Cola, their margins are definitely a strength, even though some are lagging their 5-year averages. They have a gross profit margin of 59.14%, a net income margin of 23.92%, and a levered free cash flow margin of 14.52%. And all three of those are well above their sector medians, and in some case, slightly lagging their 5-year averages. While Coca-Cola's gross profit margin is similar to their main competitors, they separate themselves when it comes to net income and free cash flow margins. Just as an example, PepsiCo has a gross profit margin of 54.03%, but only a net income margin of 9.05%, and a levered free cash flow margin of 6.86%. Comparatively. And this looks to be related to Coca-Cola's refranchising of their operations in 2017 and 2018, which fundamentally changed their operations of their business, and we can see that in their net income and free cash flow margins as they increased substantially since that time. Just real quick, if we compare those profit margins to Pepsi, we see that Coca-Cola's are significantly better. Now, Pepsi is a much more diverse business than Coca-Cola's is, with only 42% of their revenues coming from beverages as opposed to food. But even if we break down the operating profit margin for just Pepsi's beverage business and compare that to Coca-Cola's, Coca-Cola's is still significantly better. So margins and profitability are definitely a strength for them. All right, so let's take a look at Coca-Cola's debt position. So Coca-Cola has a total debt position of $41.8 billion, with $35.8 billion of that being long-term debt. And they have $15.4 billion in cash and short-term investments, though, which gives them a net debt position of $26.4 billion. And their interest expense is about $1.5 billion a year, which is more than handled by their $10 billion to $12 billion in operating income that they're generating. So overall, I would consider this debt position to be relatively healthy. Now, let's take a look at how Coca-Cola has performed in 2023 versus their full-year forecast. On their Q4 earnings call, Coca-Cola outlined their 2023 guidance, and it was organic revenue growth of 7% to 8%, primarily led by price and mix, currency-neutral earnings per share growth of 7% to 9%, and comparable earnings per share growth, including currency impact, to be 4% to 5%. So let's see how they performed up to this point. In April of 2023, they announced Q1 earnings, and they announced 12% organic revenue growth, which was mostly due to pricing, but they also saw a 3% volume growth. They had 5% net revenues, which includes the currency impact, and currency-neutral earnings per share grew 12%, while comparable earnings per share that includes the currency impact grew only 5%. In July of 2023, they announced Q2 earnings, where they announced 11% organic revenue growth, only 6% net revenue growth, including the currency impact. Currency-neutral earnings per share grew 34%, whereas comparable earnings per share, including the currency impact, only grew 11%. And then in October in 2023, they announced Q3 earnings, and they had 11% organic revenue growth again, as well as 8% net revenue growth, which includes the currency impact. Earnings per share growth on a currency-neutral basis grew 9%, whereas comparable earnings per share, including the currency impact, grew 7%. So in general, Coca-Cola has really had a great year in terms of their 2023 forecast versus actual results. They basically, at minimum, hit and in some cases crushed their 2023 guidance. And I think the real question for investors when you look at this is understanding what really your goals are and which of the numbers as it relates to revenues and earnings per share are actually meaningful for you. And what I mean by that is currency neutral really the way you want to look at it in terms of your own growth requirements for stocks that you're investing in? As an example, is your portfolio strategy about double-digit growth? Because we already know from a dividend perspective, they're not there at this point. They're at about 5% dividend growth, at least for what they gave this year. And in terms of revenues, if you look at it from a currency neutral basis, they're at 12%, 11%, and 11% in the first 3 quarters, while their own expectations were only 7 and 9%. So they've exceeded. But if you're looking at revenues that include the currency impact, which I would consider real life revenues, then it's a different story because Coca-Cola's only at 5%, 6%, and 8% for the year. Now, is that the type of growth that you're looking for or not? This goes back to understanding what your investment goals are, what your time horizon is, and what your preferred strategy is. And if it's just, I want to make money, it's going to be almost impossible to evaluate stocks in any kind of meaningful way. And just real quick, if you guys enjoy these type of breakdowns, my stock analysis library continues to build. I post analysis documents on even more companies there, as well as additional content and member-only videos. For more info, check out the link in the description. Okay, so we have a decent idea of what's happening in their business. Let's take a look at their valuation. All right, so if we look at the information that's been pulled in, we see that Coca-Cola has a cash flow yield of about 3.88%. We see their dividend growth rates here, which again, I would characterize them as probably average at best, probably a little below average actually. Their years of dividend increase is obviously excellent. Their current dilution trend is even, which ideally you want that to be down. Their moat is clearly wide because they are Coca-Cola. And even though I know that they're a steady and consistent performer, when you look at the chart over the past 5, 10, 20, or 30 years, it has underperformed the S&P 500. So if we take a look at our discounted cash flow model, after adding our cash from operations, CapEx, and stock-based comp, we get a fair value price per share of $35.18. Now that's well below the current price of $55.24. So let's look at our assumptions so we know what we're doing. In terms of starting cash flow, I just used the trailing 12 months. It's been pretty consistently up. There's a little bit of variation, but not too much. So I think trailing 12 months is probably okay there. In terms of starting growth rate, I'm literally using the adjusted free cash flow growth rate that we calculated in the spreadsheet from the numbers that we have. And then all the rest of the items are the same. Now, in terms of the discounted cash flow measure, Coca-Cola is obviously trading at a premium. And I think it tends to do that normally just because of the name Coca-Cola and the type of business that it is. Now, we have to decide whether that, premium is too much or if it's justified or not. But let's take a look at the multiples models and see if we see something a little bit different. So if we take a look at the multiples model for price to cash flow, we see that the peers that we're using are PepsiCo, Monster Beverage, and Keurig Dr. Pepper. And when we look at the price to cash flow of those, we get a fair value price per share of $67.76, which is actually a little bit above our current price. Now, we have here a 20% margin of safety, and the target price is just a tad under the current price, but still, this is a lot more attractive than what the DCF model shows. And if we see why, obviously Coca-Cola's cash flow generation and price to cash flow compared to their peers is slightly better, so it's pushing that fair value price up. And if we take a look at it for price to earnings, we see a similar story, with the fair value price per share being $66.08. And again, Coca-Cola's price to earnings compared to their peers is lower, except for Keurig Dr. Pepper, so it's pushing that fair value price up. So if we take a look at historical price to cash flow and price to earnings multiples, Coca-Cola is trading at a price to earnings of about 22 and a price to cash flow of about 20. And looking at the past 10 years, Coca-Cola is trading at an attractive multiple, especially as it relates to PE. The only other times it was at this level were during the February 2020 kind of COVID market event, which obviously was a unique event. And then you'd have to go all the way back to 2014 and 2015. And even if you look at price to cash flow, even though it doesn't look quite as attractive as price to earnings, it's starting to trend towards an area where it's hitting kind of these recent lows back in 2021, 2022, and 2020. Now, it should be noted that the period over the last 10 years were a zero interest rate policy environment, so stock multiples over that time frame may not be the best indicators we go forward if interest rates are going to be higher for longer. And I think that's part of the question that all of us as investors need to ask ourselves when we're valuing a stock. Are price multiples of the past 10 to 15 years really indicative of what we should expect, or will they be much lower if the interest rates stay above 5% or higher for a long period of time? Now, I don't know the answer to that, but I think it's something that we should all keep in mind as we evaluate these stocks and compare historical price metrics. All right, so if we look at the valuations all together, we see that the analyst mean price is actually $64.42, and that's right around what we got for our multiples valuations, but significantly higher than we got for the buy and hold DCF model. All right, let's talk about some overall thoughts and rate Coca-Cola on the 3 criteria that I use to evaluate stocks: business, operational performance, and valuation. So in terms of business, Coca-Cola is an iconic brand with a strong moat and pricing power. They have global revenues and they're in over 200 countries and territories, but they also have a lot of exchange rate headwinds because of the international mix of their revenues. Still, overall, I would rate their business as good. In terms of operational performance, they've had steady free cash flow generation, but dividend growth that's been less than 5% over the past few years. Their margins are extremely strong and, in my opinion, are a competitive advantage compared to their peers. Overall, I would rate their operational performance as okay. In terms of valuation, their DCF model is about 65% of the current price, but their price to earnings and price to cash flow multiples are starting to look attractive based on their 10-year history. So in terms of valuation, I would rate them as okay. So is Coca-Cola still worth buying now? So to me, Coca-Cola is not a buy right now, even though there's a lot that I like about it. But it doesn't actually fit my own personal portfolio strategy, which really prioritizes dividend growth. But it still could be a strong pick for investors who are looking for dividend consistency more so than growth. But let's walk through it, because Coca-Cola is a globally recognized and iconic brand with pricing power. Revenue growth across all regions continues to be high on a currency-neutral basis and actually double digits. And they're on a 3-year growth trend after a 6-year decline. Operationally, Coca-Cola has shown good consistency after they refranchised their bottling operations in 2017 and 2018. They're generating free cash flow that is slowly paying down debt, funding share buybacks, and dividends. The operational change has also improved their margins to be significantly better than their peers and is a competitive advantage. But there were a few things that I didn't really like, and one was the high impact of currency fluctuations to their revenues with the current strength of the US dollar, because their organic revenue growth rates look strong in the double digits, but GAAP reported revenues that included the currency impact were more in the 5 to 8% range. And it's just not clear to me if depending on currency adjusted revenues is the right approach for investors in the current state of the economy. And then additionally, their dividend growth has been average at best, and management has said that they want to improve it, and the 5% bump in 2023 was a decent start, but sustained increased growth is yet to be seen. So I don't currently own Coca-Cola, and even though I love their product and their stock's consistency, it just doesn't fit my dividend growth requirements of my personal strategy. But investors who are looking for dividend stability over growth and want a defensive stock that's going to be around for a while and continues to increase its dividend each year, Coca-Cola is obviously one that'll almost certainly do that. It's an amazing brand that, in my opinion, is not going anywhere, and 60 years of paying and increasing a dividend is an extremely strong track record. But that's just my take on it. What do you guys think about Coca-Cola? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.